Welcome back, everyone. In this video, I'm going to talk about stock buybacks and what are stock buybacks. So, stock buybacks pretty much are when a company buys its own stock. And why would they do that? So, for example, during the start of the pandemic, a lot of company stock price was very low. So, what these companies would do is they would buy the stock because it is not at the right price. Pretty much it is lower than it should be. At least that's what management would think, is the price is too low. So then they would buy these stocks, and then when they buy those stocks, the stock price also increases. And then I'm gonna just share in this video the benefits and also the downsides of a company buying their own stocks. One, it's gonna boost their share price, and their shares are gonna be worth more in the short term. And then two, is gonna increase the dividends because there's gonna be less shareholders, as for example, in a downturn, people are going to be selling their stocks, and when the company buys those stocks, there's going to be less shareholders. And then also, there will be a better earning per share, so the EPS will increase. And they'll also help the company beat market expectations. And pretty much on paper will make the company look like a good investment. And it can also mean companies want investors to know that they're gonna keep growing. It doesn't always happen just when it's a downturn, but also sometimes companies, when they will buy back stocks just to kind of almost like brag they're gonna keep growing. And then investors will also see that as a positive, and they will they will also invest more. Okay, and then I'll go over the downside. So in the pandemic, during the beginning of the pandemic, you don't really know when to buy the stock. You don't know when is the lowest is gonna be. So that's another downside of stock buyback, is that even management doesn't know where the stock is gonna go, because it's very hard even for professionals to predict the stock prices. So that's another downside. They can even lose money in terms of if they buy not on the complete low when the stock is going down. And then also, business is about using limited resources. For example, you don't want to use all the cash that you have. Like a company doesn't want to buy all the savings they have, or they don't want to use all the cash they have. They always want to have some cash just in case of they want to buy a new company or invest in other things. And then another downside is instead of management spending money on research and development, they're willing to just buy their own stocks. So that's a lot of that's the downside of it. And then also sometimes management will act in self-interest, and they want to get bonuses, so they will do that just so that their company can look good on paper in terms of the performance of the company. and then the CEOs get paid on, and management also get paid on how well the company is performing. So that could be a conflict. And then I also want to go over one example of a company that has done has bought a lot of its own stock, which is Apple. So this article came out last year in April. Pretty much, Apple plans to buy 75 billion of its own stock, fuels spending debate. And then if you go through this article and read the whole article, it is very important in terms of understanding. Not everybody agrees with stock buybacks, but you can also make your own evaluation of what would that mean for your investment in the company. And that's all I got. And thank you for watching. See you in the next one.